You've probably heard people talking about stocks, shares, and the stock market like it's some kind of secret club. But don't worry, I'm here to break it down in the simplest way possible. A stock is a tiny piece of a company. Imagine your favorite burger joint. Let's call it Bob's Burgers. If Bob decides to sell pieces of his company to raise money and you buy one, congratulations. You now own a small part of Bob's Burgers. If Bob's Burgers makes money, so do you. If it struggles, your investment might shrink too. A share is just one unit of stock. So if Bob's Burgers is divided into 10 shares and you own 5, you own half of Bob's empire. If Bob ever sells burgers with gold sprinkles and makes a fortune, your share value could skyrocket. People buy and sell stocks at a stock exchange, which is like an online shopping mall. But instead of buying sneakers, people are buying pieces of companies. The big ones are the New York Stock Exchange, NYSE, and the NASDAQ. Think of them as massive marketplaces where people trade company ownership. Companies sell stocks because they need money to expand, launch new products, or just keep the business running. Instead of taking out a loan, which comes with interest, they sell stocks to raise cash. When you buy a stock, you become a shareholder, basically a part owner of the company. Let's break it down with an example. Imagine someone who loves coffee so much that they decide to open their own coffee shop, Lisa's Lattes. But there's a problem. Starting the business requires $100,000, and Lisa only has $50,000. What's the solution? Instead of taking a loan, Lisa decides to find investors who believe in her dream. The business is split into 10 shares. Since it's worth $100,000 and she already owns half, $50,000, she sells the remaining 5 shares for $10,000 each. Jake, a coffee enthusiast, buys a share for $10,000. That means Jake owns like 10% of Lisa's Lattes and will get a share of the profits. Fast forward 5 years, Lisa's Lattes becomes the next Starbucks. The business is now worth $500,000. That small $10,000 investment, now worth $50,000. Selling it now would mean a $40,000 profit. Not bad for believing in coffee, right? But stocks aren't always sunshine and rainbows. If Lisa's Lattes flops because people decide tea is cooler, the value might drop. If the business shrinks to $80,000, Jake's investment falls to $8,000, meaning he lost money. People invest in stocks because they hope the company will grow and their shares will become more valuable. If that happens, they can sell their shares for more than they paid. Some companies even give shareholders a portion of their profits. This is called a dividend. Free money? Yes, please. But here's the catch. The stock market can be a wild roller coaster. One day you're up, the next day you're down. Companies can do well or flop, and stock prices go up and down like a seesaw. That's why it's important to do your research and not throw all your money into one stock. Spread it out. A little here, a little there. So if one company struggles, you don't lose everything. Some people buy stocks to trade, meaning they buy low, sell high, and make quick money. Others invest for the long term, holding on to stocks for years or even decades. There are different ways to invest in stocks. Growth investors buy stocks in companies expected to grow fast, like tech startups. Value investors look for stocks that are undervalued, meaning they are worth more than their current price. Some people focus on dividend stocks, which provide a steady income, while others invest in index funds, which spread their investment across many companies to reduce risk. Stocks can be rewarding, but they come with risks. The price of a stock depends on many factors: how well the company is doing, the overall economy, and even global events. The market can crash, individual companies can fail, and inflation can erode the value of investments. If you're interested in investing, start by learning the basics. Open a brokerage account on platforms. Decide on your investment strategy. If you're looking for steady income or long-term growth, start small. You don't need thousands of dollars to begin. Diversify your investments so you don't rely on just one stock. And finally, monitor your investments without stressing over daily fluctuations. Investing in stocks can be exciting and profitable, but it requires patience and knowledge. Do your research, make informed decisions, and don't invest money you can't afford to lose. Stocks are a long-term game, and with the right approach, they can help build wealth over time. If you like this breakdown, hit that like button and subscribe for more finance lessons.